market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, stocks higher. China says it's assessing this possibility of trade talks with the U.S. Now, Beijing cited senior U.S. officials' willingness to discuss tariffs. And speaking on Fox News, the U.S. Secretary of State, Marco Rubio, says China wants to come to the negotiating table.
Can we reach some sort of short-term accommodation with them? That's what they want. I mean, the Chinese are reaching out. They want to meet. They want to talk.
Trade tensions and geopolitical uncertainty have caused investors to diversify their portfolios and seek havens. We're delighted to be joined now by Giorgio Pradelli, a chief executive of the Swiss wealth manager EFG International, which manages more than 165 billion francs of assets. So, Mr. Pradelli, thank you so much for joining us. It's been a couple of weeks where we saw turmoil, investors trying to understand what they did. I'm sure you picked up a lot of client calls in saying what this all means longer term. First of all, how have clients been behaving?
So first of all, thank you for having me. I'm very pleased to be here. Well, you know, clients, like everybody, have been quite surprised by what has happened at the beginning of April, the reversal a week later. But I would say for the moment, we were also very impressed. Also looking back at 5 years ago or so, clients have remained very composed. They have not panicked. And depending on the asset class, actually, we saw a lot of trading activities. For example, FX, we have seen much more trading activity than before. Other asset classes, a bit more cautious.
What do you worry about the most, actually, in terms of, again, client behavior, if people want to get out of the markets, or just this volatility that could, at the margin, benefit, but also scare some people off?
Well, it's very difficult to judge at the moment. At the moment, this kind of volatility is obviously good for trading activities. For us, obviously, we worried that at some point something is going to break somewhere and then we're going to go fully risk off. But this is not our main scenario. This is not what we see. And actually, markets have rebounded very well. So hopefully this is not going to happen.
Yeah, and again, we always look at the plumbing, actually, in markets to make sure that everything's okay. For the moment, it seems that everything was fine. There's no liquidity concerns. There's nothing that makes you uneasy about the stability of the financial system.
No, this is correct. And, we watch very closely to the, for example, to the Treasury auctions. And lately, the Treasury auctions went very well. Actually, we tightened spreads. So, no, we see that at the moment, the market is after the shock. I would say there was a shock. After that shock, the market is stabilizing, and now we will see how it's going to develop. Now, can we exclude that another wave is going to come? Probably not. But for the moment, is so good for the moment.
There's also positives and negatives if you're sitting in Switzerland. I guess you're seen as a bit of a haven, but then you can also have the currency move on the back for maybe the wrong reasons.
Well, yes. I mean, obviously, for us as a business being based in Switzerland, we are a global boutique, so we are present from Sydney to São Paulo in all the major financial centers. But for us, clearly, private banking is another form of geopolitical risk diversification. At the moment, geopolitical tensions are very high, so obviously we benefit from that trend. On the other hand, we report in Swiss francs, but 50% of our assets under management of our clients are in dollars. So clearly for us, a weak dollar is not good for us. So this is where we see the other impact, which is not positive for us.
Do you think, and this is something that we've been trying to speak to, senior bankers, we asked David Solomon of Goldman Sachs, Bernie Mensah of Bank of America, whether the geopolitics actually means that you win and lose business depending on where your headquarters. Will European financial services get a bit more business from people that look at the U.S. and say maybe that's not the right time to bank with them?
Well, that's a very good question. It's very difficult. But what we see is that, for us, for our business, what is important is wealth generation. Mm-hmm. And for the moment, wealth generation is still okay, but also where the wealth is moving. And for us, it's very important to be very close to our clients. And at the moment, we see that actually clients like the safe haven of a Swiss private bank or Switzerland, but in general also of all the other financial centers. We are based here in London, and we see that actually London is doing pretty well in terms of capturing these flows. So we will see how it's going to develop, but for the moment, is good. So we are quite confident.
Are you eyeing any new parts of the markets? I don't know whether we should be looking out for any new banking licenses in any parts of the world, or even M&A.
No, let's say in terms of our footprint, we are fine as we are. We are present in the major financial centers, as I said, from Australia to Hong Kong, Singapore, London, Luxembourg, Monaco, and Switzerland. And on the other side, we are in Miami, Cayman, and Bahamas. So we are okay in terms of footprint. But, for example, we opened a desk here in London to cater for Asian clients. We have seen that some clients from Asia, they actually like to diversify into Europe. And what we see is that, diversification, which is for us a mantra, a key, is not only about asset classes, but is also about financial centers. So we see that wealthy clients are trying to move their assets. As you know, there were anecdotal evidence some American wealthy clients are coming back to Europe, but some Europeans are looking at Asia. So at the moment it's very fluid, and you need to be close to your clients, and you need to have people that can talk the language of your clients.
Have you seen UK clients, and this is one of the big stories that we're trying to follow here in the UK, have you seen wealthy UK clients actually move out because of some of the tax regimes imposed?
Well, yes, I think that is a fact, and because of the changes, we have seen UK clients moving, and to Dubai, to Switzerland, to Milan, to Jersey, depending on the preference. But what we have seen, on the other hand, is that they still keep a lot of the assets here, the reality is that wealthy clients are global citizens, so they might move a part of the family, they might move their residency, but where they manage money doesn't always overlap.
Are they optimistic about Europe? I think 5-6 months ago, there was so much hope that the U.S. would power ahead, and actually Europe, there was a danger that it was really left behind. And now it feels like if they do the right things, they could catch up.
No, actually, I think even in January when we were in Davos, I think that, we started saying that maybe we should rotate back into Europe. Obviously, we did not expect the 2nd of April, and we did not expect the change in Germany, which I think is I lived in Germany many years. I think it's historic what has happened. So I think Europe will do, I think, pretty well. The continent is pretty resilient, and if really Germany is going to invest all this, almost $1 trillion in infrastructure and other sectors, this for sure will stimulate the activity in the continent.
When you look at U.S. clients, or actually that U.S. base, are they waiting for trade to kind of settle down before they decide where they allocate money? Or no matter what happens, there's been a shift?
No, I think, I don't have real evidence, real data about the behavior of American clients, but I for sure see that there has been a move out of equities, that's clear. Now, for American clients, some clients love to go abroad. Other clients are very more domestic oriented. So this is we will see how it's going to develop. But anecdotally, we have heard that clients are coming back to Europe, are coming back to Switzerland, coming back to London. That's for sure also a trend.
Giorgio, you're talking about the footprint, and you were saying that you're pretty happy with the way it is now. Is there anything on the table that you would be looking to buy to add non-organically?
Well, yes. I think, our strategy is primarily an organic growth strategy. Sustainable and profitable growth has been our mantra since 2019, and we have delivered pretty well. Now, obviously, we like also to make M&A. We have excess capital. Our business model is capital light growth model, so we have excess capital. And we made a small acquisition now in February. We would love to add to where we're already present. We have simple criteria. We would like, as I said, to add where we're already present. For us, it's very important the cultural fit, because our culture is quite, entrepreneurial and I would say progressive. And on the other hand, we need obviously to pay the right price in order to achieve a return on investment of 10% over 3 years.
So this would be similar to what you bought with Cité Gestion in Switzerland, or is it also something possible cross-border?
No, also cross-border. We would love to make acquisitions in Asia. We would love to make acquisitions here in London. We would love to make acquisitions where we're already present. Now, at the moment, I must say, everybody talks about consolidation, but there are not many targets around. Now, we try to obviously be very active, and we are scouting the market all the time. But yes, we would love to do that, and we are trying to become much more systematic in the way we look at possible targets.
Why not many targets? Because it feels like actually there could be an opportunity given the market turmoil.
Well, as always in our capitalistic model, you need a willing buyer and a willing seller. So we are a willing buyer, not always we find the willing sellers. So, but on the other hand, obviously people know that we are interested. I think we have a good framework. I think that we know how to integrate to create win-win situations also for the companies that join us. So overall, we hope that Cité Gestion is the first of a series of acquisitions.
Wonderful. Thank you so much for joining us today. That was, of course, Giorgio Pradelli, the Chief Executive of Swiss Wealth Manager EFG International. Coming up, we talk tech. Apple and Amazon actually failed to reassure investors about the potential impact of U.S. tariffs. We'll dig into the earnings stories next, and this is Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
Oh boy, do we have a wow number.
I would look at this as a shock to the economy.
Does it bleed into the labor market?
The hard data isn't bad. The soft data is terrible.
Today, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
The labor market is still showing the kind of strength it has been showing.
The totality of data is showing that strength.
The April jobs report, today on Bloomberg.
The corporate room, the corporate C-suite is very much pulling back. Everybody who was an investment bank attached to their business says that the deals that we thought would happen, the capital markets deals, that's absolutely all slowed down. If you're a corporate, you're thinking through what's my CapEx like, where should I invest, are these tariffs here or not? And so why would you go out and make big decisions around that?
Well, that was Bernie Mensah, president of International at Bank of America, speaking to me yesterday about the impact of U.S. tariffs. Now, Apple and Amazon's latest quarterly reports failed to quell investor concerns about tech and tariffs. Speaking on an earnings call, the Amazon chief executive, Andy Jassy, addressed the current trade uncertainty.
Obviously, none of us knows exactly where tariffs will settle or when. We haven't seen any attenuation of demand yet. To some extent, we've seen some heightened buying in certain categories that may indicate stocking up in advance of any potential tariff impact.
Well, Apple's China sales disappointed. It warned of damage from the trade war. Bloomberg's Charlie Wells is here with the details. Hi, Charlie. What do you have?
Hi, Francine. So what investors had been waiting for was this forward guidance. And when they got it, they didn't like what they saw. Let me give you an example of that. Here's $900 million. On the earnings call yesterday, Tim Cook said that is the amount in the current quarter that Apple could face in higher costs from trade tensions between the United States and China. He also talked about China, and we need to remember how important of a market this is for Apple. We know all about these production woes, but it's also that crucial market for sales, third most important globally, and Apple reported 2.3% in declines in sales in China, which is going to take a significant hit for them. We also need to speak to the issues that Amazon as well has been having as far as China. We know that they get a lot of their supply from China, but we also need to focus in on some of the sales softness that we saw at Amazon. They did post growth of 17% in their cloud unit. That is slower growth than what we saw in prior quarters. We also know that Microsoft had that blowout number yesterday, so some competition here. When you add this all together, you can see how these shares are performing in pre-market. It is definitely not looking positive for them when you take a look at least this early trading. And this is adding to this narrative that we're getting in the Mag 7 of a divergence here between these software companies that markets actually like when they post their earnings and these more hardware, retail-oriented businesses that take something of a hit.
Charlie, thanks so much. Charlie Wells there with the very latest on some of these earnings. Now, we're also joined by Ursua Marchioni, head of investment at Portfolio Solutions at BlackRock, and Bloomberg's Kevin Whitelaw. So Kevin does the politics, which, you need like a full-time job to try and understand exactly what's being said. And Ursula, who has a double-side job because he's trying to understand what the markets are doing. Ursula, look, there's a lot of optimism today that we wait for jobs, but that there's going to be some kind of trade, at least talks between the U.S. and China. I don't know what's priced in the markets right now. They're somewhere in the middle, so it's not worst case scenario, it's not better scenario. I think it's just difficult to model.
I agree with you, Francine. I think that obviously good day to be on, sunny and upbeat. But if you take a step back, there's definitely a theme of duality in markets at present, which you see playing out in different facets. On the view of the US economy, and so again, soft data and hard data pointing to slightly different pictures. Duality in terms of investors' behavior and positioning towards US assets. And so US dollar treasuries on one side, US equity on the other. And then duality in terms of what we are seeing clients doing in their portfolios. So I think you're pointing in the right direction in the sense that if I start with the first of these three elements, soft data have been weakening. There's been some disappointment. Michigan, PMI, we've seen some softness coming through. I think on the hard data, to your point, we'll see, because the one coming up today with payrolls is really the first one post-Liberation Day. But so far, despite GDP contracting, we know why that is happening. So we feel that the picture is still intact. But one of the two sides has to converge towards the other. Similarly, in terms of assets, we see selling of US treasuries. We've followed the debate, especially towards the long end of the curve. The US dollar is under pressure. US equities continue to be bought. And so we were chatting around repatriation. For sure is happening. European clients are buying more European equities, but we still see a lot of US equity buying, particularly in the US. The domestic investor is buying on the dip. And so I think repatriation is happening, but it's not necessarily great repatriation yet.
Yeah. That's interesting. I mean, there's a lot, and I feel like in the market, maybe there's, a lot of market participants wanting some kind of trade deal. And it's unclear, Kevin, when you listen to what the Trump administration actually says, they haven't really backed down. They're saying that they'll get a deal, but there's no backing down. And then today there's also the de minimis. So if I'm a consumer and I buy something from China, I get taxed and tariffed.
Yeah, that's right. I mean, Trump has talked about these tariffs in so many different ways for so many different reasons, for so many different objectives, that I think everyone's still trying to sort out exactly what that is going to mean in terms of what he's actually looking for. Yeah. And at some point, it's going to be a question of whether that economic pressure, the market pressure, all of that is going to essentially force him to accept deals that were way, way, way less than some of the things that he suggested he's wanted. And that may become the case with countries like Japan, it may become India, and it may even be the EU, depending on where they go. But there still remains that concern that he is simply looking for things that countries are unable or unwilling to offer. But you are watching the effects start to play out in ways that consumers are going to notice. Yeah. The de minimis one is interesting because on some level, this is about small packages. This is about ordering things from Amazon or Temu or Shein, and it is about trying to sort of stop what had become, from the Trump perspective, a bit of a loophole for avoiding tariffs. This really is mostly small products, but it is products up to $800. Yeah. And so, there is some ability to try to, I think from the Trump side, constrain that ability for the Chinese sort of to be flooding low-cost goods into the U.S.
And how do you manage that volatility, again, until we figure out exactly what the end goal is of all of this exercise?
Agreed. So I think that as we decode how supply chains will evolve, and are we going to see a hit on margins if companies take the pain or they pass it on to the consumer, and so we're going to see a hit there. I think we have to go back to that duality element that I mentioned. So from a long-term perspective, I'll quote my colleague and friend Simona Paravani, who's the CIO of our solution business within multi-asset. She summarizes by, we know the starting point, but we don't know the destination. We don't know where we're going. And as I speak with CIO in the UK, on the continent, that is clearly the theme that is emerging. So my view is that it is an opportunity to continue to buy on dips on the themes that we have conviction on. So, for example, European banks will be one. Another one would be the AI theme. We've seen it this week through earnings, particularly software and AI adopters. So trying to capture a broader component of the value chain around AI beyond, simple tech. So that is clearly an element. But again, Francine, I profoundly believe I pick up strong desire to redesign benchmarks. So I think that end point that we're going towards will be different. There'll be, less world, more Europe. There'll be less market cap, more equal weight. So that's one element. In the short term, and so that's the other side of the equation, we need to continue to be defensive. And so ideas such as, from a factorial perspective, minimum volatility, quality, high income stocks, great way to buffer potential downturns, and from a sector perspective, utilities and healthcare. So I think these two perspectives need to be very crystal clear in every action that we take in portfolios.
Oh, I want to ask Kevin about the security advisor in a second, but how do you deal with stagflation risks? Because that's kind of, again, it's too soon maybe to worry about it, but it changes everything if it happens.
It changes everything, and we have seen such a pickup in terms of scenario testing that our clients ask us to help them do, and the frequency of requests around what you're describing is clearly, skyrocketing. So I think there's a theme of diversifiers within portfolios. So, strategies along the lines of absolute return, systematic, long, short, as well as more classic ways to diversify. Think about gold, which has obviously done a lot, but as we follow the philosophical discussion around the dollar and what is its future, I think there's still an element there. So you're right, Francine. I think that element of the tail risk, that tail has become fatter, and so we need to pay attention to it. 100% agree with that.
And then again, I don't know what to do with the Trump approval ratings, whether that will change policy. And Mike Waltz got kicked out as national security advisor. So, I mean, Rubio has many jobs, but also is this because of the approval ratings, or was it really because of the signal leak?
I mean, I do think the Waltz ouster was almost entirely about Signalgate. And I think also the way he reacted to Signalgate by trying to sort of pretend that he hadn't made a mistake and that it was somehow a software glitch, which I think didn't really fly with anyone who's really used iPhones or Signal. So I think that never quite tracked with people, and I think that ultimately that simply became too much of a problem. There also were a couple outside Trump allies who were campaigning against him quite openly, and I think that may have been an influence as well. I think more broadly that approval rating thing is going to become a problem for him. His approval ratings really are low. It's not going to be yet, but at some point Republicans in Congress are going to have to be looking, they're going to start turning their attention toward the midterm elections. They're going to start thinking about their futures. They've got something to worry about there. And it's the same dilemma they've had all along, is Trump can win them primaries, but increasingly may not be able to win them general elections. And so they're going to have to at some point make some difficult decisions about when they want to say no to Donald Trump. And I think that's the thing we'll all be looking for.
Okay, well, thank you both for joining us. Ursua Marchioni, Head of Investment and Portfolio Solutions at BlackRock, and Bloomberg's Kevin Whitelaw. Now, this is Bloomberg. We have, of course, that big jobs data a little bit later on. That's pretty much the finish of a very busy week, so we'll have a market check. This is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Global stocks make gains as China hints at possible trade talks with the U.S., but Beijing says unilateral tariffs must be scrapped first. Amazon and Apple disappoint with warnings about the potential impact of U.S. tariffs on their costs. Natwest and Stanchart earnings beat as traders cash in on volatility and customers show resilience. Now, Bloomberg has learned that the EU is planning to share a paper with the U.S. next week, setting out proposals to kickstart trade talks with the Trump administration. Now, on top of tariffs, the continent is also trying to get the U.S. on side when it comes to discussions to end the war in Ukraine. Now, let's discuss all of this with the former Italian Prime Minister Enrico Letta. Mr. Letta, thank you so much for joining us. I mean, first of all, geopolitics is pretty complicated at the moment. It's, it changes by the minute. What's your assessment of the role that Italy has at the center of geopolitics right now? Can it be a help and a bridge between the U.S. and Europe?
This is what the government is trying to do. I think it's not easy for a very simple reason. I think that Europe has to be united today. And if I'm not wrong, it's the only way to convince Trump and not to be I would say, too aggressive against Europe. The only way to convince him is to be united. And the European Union, we are lucky because the rules are allowing us to speak with one voice, the famous single telephone number that Kissinger asked in the past. We have it on trade. And so I think it's very important for Europe to use this single voice on trade that is crucial and fundamental. For the rest, all the efforts to, I would say, to keep the two sides of the Atlantic more united are good. And I think if Italy helps and if the Italian government helps in that direction, I think it can be good. But some degrees of skepticism in the way in which with Trump that can be useful.
What do you see the future of Europe? Again, it feels at times where this could be the moment that Europe stands up, does better, and actually has a real voice, or it could be stuck between this U.S.-China trade war.
In reality, Trump pressure can be a great opportunity for Europe. I'm among those thinking that Trump can be a great federator from abroad, because it is clear that today we have to be united. There's no possibility to be successful fragmented. And the other key point is the fact that the European Commission program, the competitiveness compass that von der Leyen presented 2 months ago, is very much oriented in integrating the European single market, because the most important fact is the single market. The single market is our strength, but in reality, we are united in some part of the single market. We have the same currency, almost all the European countries. But for instance, on finance, on telecom, on energy, we don't have one single market. We have 27 markets. And that is a big, big issue for Europe. This is why for me, the most important achievement should be passed from 27 to 1 in these fields. So financial markets, telecom, and energy.
Do you see an appetite actually for Europe to become more competitive? And if you look at some of the big changes that we've seen since the start of the year, maybe German defense spending is something that we weren't expected that could really catalyze the region.
I think defense would be an important boost to be more integrated, because you have countries that are not very happy in having European common fiscal capacity, in theory, like Germany or like, for instance, the northern countries or like the Netherlands. When we move to defense, they want to have a European fiscal capacity on defense. They seem to be open on that. And that can be a great leverage, in my view, to find more integration in finding resources. But I am strongly convinced that the true point for Europe, the game changer in Europe, will be the creation of one single market on finance. The fact that the European Commission took the proposal of the Savings and Investments Union, so passing from the unsuccessful capital markets union of the last years to the new savings and investments union, with the idea to mobilize private capitals for the European common goods with one financial market and not 27 financial markets. I think this is the game changer. The Commission presented the proposal, and I think it's a good first step. I know the countries, and many countries, are pushing in that direction. We have to be fast on that.
Do you think Vladimir Putin is playing Donald Trump on this Russia-Ukraine possible peace deal? And where do you see the conflict headed?
Frankly speaking, I would be very happy, and we are all waiting for a ceasefire, for true negotiations, for agreements. But I think my guess is that the present U.S. administration was, until now, a little bit superficial in considering how easy could be to have a peace agreement. Peace agreement is very complicated. and it's complicated also for a very simple reason. We have to agree on one point. Are the Ukrainians free to decide where they want to be or not? This is the key point, and this is the key difference between Europe and Donald Trump. Because the feeling is that in the US administration today, there's an attitude that is different, in which it is, I would say, a great conversation between the great leaders that will decide where Ukraine has to be. For us, the Europeans, I think it is in the hands of the Ukrainian people to decide. And this is, in my view, the key difference, the key issue. Then we can have, or they can have, discussions on territories, on borders, but the substance, the core is, do we agree that is in the hands of the Ukrainians to decide where they want to be? In Europe, close to Russia, where? And it is their decision, not our.
Mr. Letta, what do you most worry about, actually, given all of this turmoil? Is it that Europe maybe splinters? Is that, what President Trump is trying to do? Or is it that prime ministers just have too much to deal with, and so maybe don't focus on the single most important thing, which is reconnecting with the voters?
I think your third point is very important. The key problem for Europe is today we are after a long period in which the European Union was obliged to react to crisis. And reacting to crisis is something that Europe can do and is prepared to do. The big problem is that today we need to plan, we need to act, not to react. Because in reality, what I said before about the integration of the single market, something that can't be just a reaction. We have to plan to build up the savings and investments union, to build up one telecom market in Europe, one energy market, and we need to be focused on that. The big risk, as you said correctly, is that tariffs on one side, Ukraine, Russia on the other side, will absorb all the political energies. And in reality, the agenda of the European Union has to be competitiveness and security. And when I say security, I say energy independence, I say the capacity to have a connectivity, unique connectivity, the capacity to be independent in terms of technique. I'm a little bit scared when I listened some weeks ago, Elon Musk addressing Ukrainians saying, if I disconnect Starlinks, you collapse. Because in reality, that could be also the same message for the Europeans. We are dependent on technology, we are dependent on satellites, we are dependent on finance, and we have to be more autonomous and more independent. And this is a plan that Europe has to run.
Mr. Letta, thank you so much for joining us. A lot to unpack there, so I hope you join us again really soon. Enrico Letta, the former Prime Minister of Italy, Jacques Delors Institute President and Dean of IE University. Now, since Donald Trump returned to the White House, Elon Musk has been a scene stealer, gutting government agency and sparking litigation. But Doge has not lived up to its billing, while Tesla has become collateral damage. Well, that's the topic of our weekly doc.
The marriage of money and power is nothing new, but the arrangement between billionaire Elon Musk and President Donald Trump is like no other in the history of U.S. politics.
Come on up here, Elon.
They're buddies. That's probably a good description, at least how Elon Musk sees it.
Donald Trump needs his fall guy, but he also needs the bulldogs, and sometimes they're the same person.
It's been a crazy 100 days.
You look around the U.S. government right now and you see friends and allies of Elon Musk in all these various departments, in all these various top leadership roles.
Trump has been able to get Elon Musk to help propel through all the changes that were spelled out in Project 2025, a blueprint for reshaping the government.
In Doge's mind, they've been wildly successful. And on the flip side, there is a cost to laying off federal workers. years to fighting all of this litigation in court.
Musk is known for his uncanny ability to play a long game, but he may not have expected so much public blowback.
So Tesla's sales really dropped. Their first quarter sales were 13% lower than the quarter a year ago.
Starting in May, my time allocation to Doge will drop significantly.
As Musk pivots, the struggles surrounding Doge's actions continue, while many Americans are reeling from a tumultuous 100 days.
Musk isn't really leaving the Trump administration.
It's not like Doge is ending. I mean, Doge is a project that's supposed to continue until July 2026.
One thing we've learned over this last 100 days is that there is going to be a huge cost to Elon Musk for doing the things he's doing. He has basically taken his personal brand and tarnished it. And that's what happens when you put yourself front and center of some extremely controversial and often unpopular policies.
Well, you can get more on Elon Musk's relationship with President Trump in the new edition of the Bloomberg Weekend newsletter, which has deeper analysis, but also feature pieces and profiles that provide unique insight into the latest news from around the world. Now, here in the UK, the Prime Minister Keir Starmer's government, Labour Party, has lost a parliamentary by-election to Reform UK Party, led by Nigel Farage. Labour went into the election defending a majority of more than 14,000, but they lost a seat near Liverpool by just 6 votes, making it one of the tightest margins in British electoral history. And Australians vote in a national election tomorrow that's been dominated by the cost of living concerns, but hasn't escaped the shadow of the Trump trade war. The Conservative opposition leader Peter Dutton began the campaign with a healthy lead, but as Paul Allen reports, more recent polls suggest that Labour's Anthony Albanese could become the first Australian leader in more than 20 years to win back-to-back elections.
Saturday is election day in Australia, and already more than 3 million of the country's 18 million voters have cast an early ballot. For those still undecided, this election's boiling down to one key issue.
Is anyone feeling that you're better off today than you were 3 years ago?
Cost of living and runaway real estate prices are top of the domestic agenda. It's a battleground where both opposition leader Peter Dutton and Prime Minister Anthony Albanese seem comfortable. Trade and foreign policy, though, have left both leaders squirming after President Trump imposed a shock 10% blanket tariff on all Australian imports. Dutton initially copied some Trump policies, including spending cuts styled on Elon Musk's so-called Department of Government Efficiency and ending work from home for civil servants. He's since dumped those ideas and has been distancing himself from the US president.
We trust the United States, and I don't know the president. I've not met him. The Prime Minister obviously has been able to.
So you're not willing to say you trust Donald Trump?
I don't know Donald Trump is my point.
On the same debate stage, Albanese also swiftly moved on from the issue of trust in Trump.
I have no reason not to. I've had a couple of discussions with him.
Do you trust China's president, Xi Jinping?
I have no reason not to either. China's our major trading partner. 1 in 4 Australian jobs depends upon trade. It is in Australia's national interest to have a good economic relationship with China.
Australia has already made a $500 million down payment to the United States under the AUKUS Defence Pact, which will see Australia receive nuclear submarines. Neither major party wants to risk sinking that deal by alienating President Trump, nor risk creating a fresh round of trade tension with China by getting too close to him. Unlike the price of eggs, those issues are too fragile to be on the ballot this Saturday. Paul Allen, Bloomberg, Sydney.
Coming up, emerging markets have outperformed during President Trump's first 100 days in office. We'll discuss the outlook with Pimco's Yacov Arnopolin. This is Bloomberg. Welcome back, everyone. It's been another bumper day of bank earnings. I feel like we say that every day. Beats from both Natwest and Standard Chartered. Now, Natwest has pointed to improving earnings this year as the bank's customers proved resilient to the unfolding strains of the global economy. Standard Chartered saw the bank's wealth and financial markets units driving profit, while the bank's chief financial officer, Diego De Giorgi, spoke to us earlier about the impact.
We don't see evidence of a real asset reallocation away from the US or away from the dollar. We are seeing it mostly, as I said, in the nature of the investments. The investments in the short term are becoming more defensive.
Let's bring in Tom Metcalf, Bloomberg's managing editor for EMEA Finance and Investing. So what stood out to you, Tom, and welcome back to the Pulse.
Thank you very much. Yeah, I think on Standard Chartered, it was this big wealth inflow they saw, how strong that unit is performing. I think the CFO brought that up on the TV show. And broadly speaking, it's been a funny quarter because banks like Standard Chartered saying they're doing very well, saying they're not seeing too many sort of ructions from all the tariff turmoil. But at the same time, obviously, that's in the back of everyone's mind. And pretty much every bank we've been covering has had a pretty strong quarter, pretty benign at least. But obviously, when you look at the share price today, for example, Standard Chartered actually down slightly. And I think that's just the sense that, you know, everyone's in wait and see still. And maybe the second quarter will give a bit more clarity on, you know, exactly how to position yourself around bank stocks.
Yeah, early days. But again, for the moment, okay, Tom, thank you so much for of course, all of the work that you and your team have done in earnings season. Now, emerging market traders are shifting their attention to the path of the global economy and the U.S. dollar after assets from across the developing world posted unexpected gains at the start of Trump's administration. So let's discuss the outlook with Yacov Arnopolin, emerging markets portfolio manager at Pimco. Yacov, so good to speak to you. I mean, there's been quite a lot of you know, different market reaction from the emerging markets. Is it still the difference between the ones that did the structural works and the ones that haven't?
Yeah, well, good morning. Thanks for having me on. Obviously, there's always a lot of moving pieces in EM. Yeah, but ultimately, we've had a very distinct reaction because naturally, even the tariff rates imposed on Liberation Day on various emerging markets have been quite distinct. LATAM on the lower side, closer to 10%. Now, Asia, obviously, much harder hit. But you know, we have to recognize this is not growth positive for emerging markets, far from it. Yep. And yet, to us, equities here are far more exposed and far more vulnerable than fixed income. Look, also it's interesting, EM currencies, EMFX, has actually been bolstered by the weaker dollar, right? So to the extent we've had EMFX stable or even stronger, that means less of an inflationary pass-through, so less concern for central banks. Very much.
So actually, you know, for the moment, I guess it depends the level where dollar settles, and no one likes volatility. But if it stays around these levels or even continues to weaken a little bit, who benefits the most?
Look, if you're an EM central bank and you recognize tariffs will certainly be a growth shock and potentially a demand shock, if we look at places like Mexico, Colombia, Brazil, the growth backdrop is challenging. But the good thing here is that stronger currencies, stable currencies, allow them, as I was saying, no inflation pass-through, so they can actually cut rates, introduce anti-cyclical measures to bolster growth as much as possible.
Yacov, when you look at some of the regions that you cover, does it depend on whether you're trading with China? Actually, is that the big difference? That if you're exposed to China, then maybe you're going through a tougher time. But it feels also that the Chinese economy is stronger. So some of the, for example, the Asian countries could benefit from that indirectly.
It certainly matters. I think again, it's about figuring out the supply chains and where is the direct hit going to be. To us, again, Asian effects may be more vulnerable on the back of that because the tariff shock has been greater. Therefore, more reason to weaken the effects to accommodate the tariffs. Having said that, fairly concerned about Europe. So to the extent the U.S.-China standoff continues, and there are fewer of Chinese exports going to the U.S., where will they go? Well, they'll probably go to Europe, meaning more of a disinflationary impact towards Europe. So if you look at our positioning, we've been quite constructive on the back of that on CE3, so Eastern European local bonds, places like Hungary, Czech, Poland.
What about Brazil and Colombia, for example? I know there are some of the countries that you're looking at with the idea, again, if they have stronger currencies, that it means that they can cushion the impact from inflation.
Yeah, look, that's where front ends of local curves make a lot of sense. Yep. In Mexico as well, when we look at the currency, people are quite surprised. The Mexican peso is stronger against the dollar than it was going into the U.S. election. People say, well, why has EM been so resilient? And it comes down to the fact that people just don't own the asset class. It's so underallocated. We've had years and years of outflows as investors moved capital out of EM into the U.S. So now, again, why the resilience? Because no one really needs to sell it. No one needs to sell the asset class. And if anything, we're actually witnessing more European, U.S., Canadian pension plans thinking about allocations and likely shifting more towards EM hard currency and certainly far more towards EM local.
What about Mexico? What do you do with Mexico?
Look, it's I have to say President Sheinbaum has dealt with the Trump administration very, very deftly.
Yeah.
So they're constructive on credit, sovereign credit, quasi-sovereign credit. Local fixed income makes sense, again, because of this low growth backdrop, and fairly constructive on the currency. So I'd say that probably is a country, while was expected to be in the U.S. crosshairs because of how well they've navigated this environment, and actually been one of the EM beneficiaries.
Yeah, I guess the problem with figures such as President Sheinbaum is that you don't know how long the friendliness lasts.
Sure.
So for the moment, she's been very able. She's been able to, tactily, I guess, negotiate. But the Trump administration can turn around.
Absolutely. Have to be cognizant of that. This is where I feel people forget just how much remittances, in other words, money sent by the diaspora back home to relatives back home, have been supportive of some of these emerging market stories, and how countercyclical they are. Because in times of stress, in times of uncertainty, people actually send more money back home. So we saw it during Trump 1. We're seeing a spike in remittances now with Trump 2. So back to Mexico, 3.5% of GDP in remittances, something like $65 billion, highest ever. Then in Washington, D.C. last week, I saw the finance minister of Mexico, Guatemala, Pakistan, exactly the same. So sky-high remittances on record, same for Guatemala and Pakistan, which again are supporting these currencies, supporting the home countries, supporting the current accounts, and actually creating stability in times of instability.
What surprised you the most in the last 3 months?
Look, I think it's as always, sometimes it's more the idiosyncratic stories, because to me, when I think about EM sovereign credit, that's probably going to be fairly resilient despite all this tariff headlines. But we look at idiosyncratic stories. Looking at the elections in Romania this week, there'll be elections in Cote d'Ivoire, Ivory Coast later in the year, and a very positive resolution in Ecuador. So the market-friendly candidate, Noboa, was re-elected. More IMF engagement, and in the meantime, you have bonds trading high double digits, well, high teens rather. So a lot of interesting opportunities, and I think people, if you kind of parse through everything that's going on, certainly a few gems emerge.
Yacov, when you look at, I guess, the modeling is extremely difficult. Mm-hmm. Do you actually look a lot more at the oil complex and the energy complex to decide what you do or how you forecast some of these emerging market countries?
Inevitably. And that's also a question mark of how long do low oil prices last, and do they go lower from here or stay at these already somewhat depressed levels? So there, one place where we've been very, very involved, that certainly has been buoyed by low oil prices, is Turkey. And another, I mentioned Pakistan already. Again, very sad to see this, the tragic terrorist attack and the current standoff, the saber rattling, which we very much hope comes to an end very soon. But Pakistan has a huge benefit. Sri Lanka, a huge benefit from lower oil prices. So to the extent the India-Pakistan standoff hopefully abates, that's a place where you can have really solid returns on their fixed income, and the country has been growing out of the crisis of the past couple of years.
Yacov, thank you so much, as always, for joining us. That's Yacov Arnopolin, Emerging Markets Portfolio Manager at Pimco. Now, don't forget the new edition of the Bloomberg Weekend Newsletter, which I think you can get from today. It has analysis, feature pieces, profiles that really provide some unique insights into the latest news from around the world. Up next, Bloomberg Brief. Of course, today is also U.S. jobs. Look, investors may be betting that the Fed will accelerate the interest rate cuts to head off an economic slowdown, but will we get confirmation of that today?